Alternative investments have been a big theme, and they just continue to come up in conversations. And I think what's interesting, and I think you want to pay attention to this, is alternative investments are generally meant to be something different than stock or bond or traditional investments. They're in general, there's limited liquidity, and some of that limited liquidity is very valuable for the private equity or alternative investment manager, meaning they're not constantly worried about distribution of cash or a shareholder saying, I want my money back, and them having to meet a redemption. Think of that in the real estate market, right? If you own a pure play alternative investment in real estate, well, real estate's illiquid. So I think one of the things you got to pay attention to when you're building an alternative portfolio is that liquidity. And are you willing to give up the liquidity for that illiquidity premium or hopeful excess return over top of investments that are liquid? So the kind of in a roundabout way, bringing this back home, when I look at alternative investments and how much focus has gone into them and how these big institutions are now making them widely available, I think the thing you have to pay attention to is how liquid are those investments, and the more liquid they are, does that take me further away from my investment thesis of saying I want to own real estate because of the stability of real estate? If we are liquid in that, that starts to water down and change. That's not necessarily bad. It's just different. And so I think that's a key part of the evolution of alternative investment products coming to market right now. I think you have to pay close attention to that. I'll give you one example. Um, Take real estate, right? I think real estate's a very easy one to relate to. Everyone understands kind of owning an apartment complex or industrial property, getting cash flow, having lots of stability because those asset values don't just go up and down and change every day. Let's say you own that in a non-traded or a private REIT structure. Okay, well, that REIT, again, private REIT, they're going to price their net asset value based on the actual appraised value of that real estate within reason. A lot of that's run with technology, but it gives you a very clean look at the actual value of the real estate. Take a publicly traded REIT, right? A publicly traded REIT has a ticker symbol and can be traded in the market daily when the market is open. What we typically see is that publicly traded REIT has the volatility like a stock investment, meaning it will go up and down as the market trades up and down. Most of the time what happens is if, let's say, the par value of the underlying real estate is $10, so in our private real estate structure, you've got $10 worth of real estate. If you own that same real estate in a publicly traded REIT, the $10 is there underlying, but if the stock market is doing better, the value of that public REIT may be higher than $10, creating a premium. Well, that real estate underlying is not necessarily worth more, but because of the tradability of that security, you're pushing that value higher to create a premium. Well, that also works in reverse. You can see in times where markets get volatile, the $10 value of real estate drops lower at a discount to the market just because of the tradability of that and marketability of that security. I don't want to own real estate for volatility. That's not why we buy real estate. We own that to counterweight the volatility in our portfolios.